everybody. Welcome to This Week in Pre-IPO Stocks podcast. With me, Clint Sorensen, Chief Investment Officer of Wealth Shield, an outsourced CIO and investment research company. Nick Fusco, CEO at PM Insights, a pre-IPO secondary market pricing company. And the world's greatest, Evan Cohen, co-founder, Chief Operating Officer at withvincent.com, a media company focused on alternative investments. Okay, fellas. A lot of people talking about OpenAI and people leaving, right? Resigning from the company. Here's the thing. This is the question I have for you guys. Some of these folks were in there early on, and this company is now worth $150 billion valuation, right? The stock, these are people. The stock that they had is worth a lot. Like I looked at Mira Murati, who is the CEO, or I'm sorry, the CTO, right? Chief Technology Officer. She joined in 2018. I have her equity worth at least $1 billion. Okay. So here's my question for you guys, right? If you're at one of these companies, you're at a company and your equity is worth $100 million, $500 million. Are you staying at that company? Or are you going to go and start your own company? Or maybe just go and hang out at the beach for the rest of your life? Like, that's a lot of money, man. $100 million is a lot of money, much less $1 billion. You're a billionaire, right? So like, I don't know. What do you think? Like, Nick, go ahead, kick us off, man. What do you think?
Sure.
You on the beach?
So let's say it's a 9-figure personal windfall, right? Or
right.
more in her
Fair.
case. It's all about what she wants to do personally, right? So I think every one of us or anyone you ask can have a very, very different answer. But like many things, startups are an extension of the founders, and
right.
it also depends, I think, on like how hard is she drinking that Kool-Aid? Is she going to be really happy sticking around? Or is there another flavor that she thinks she could build of what the current incarnation is? But I think there's a big difference with OpenAI rather than if you work at Ford and you just raked in 100 million. You know, you're out of there. You do whatever the hell you want. But I think with OpenAI, you can't just make OpenAI 2.0 that's a little bit more like the business that you want. Because getting it off the ground is going to be so much harder. So maybe Ford's also a bad example because let's say you start the next Rivian. The barriers to entry on these companies are just so high these days that I don't think you can necessarily easily parlay it into the exact new form that you want.
Sure.
But if you want to bugger off and go to the beach, yeah, that's an easy one. Like, find a beach, find a mountain. Yeah, but
it's hard.
I think but if you're seeking fame or you're seeking to build something just outrageous, it probably was a really tough decision, I would say.
Yeah.
You know? So
Clint, I'm going to do you last because you and I wax about purpose in life all the time. But Evan, what do you think? Like, what do you think about this? Like, these are people, right? And they just made a lot of like generational wealth. I have to imagine that comes into the conversation versus like what a lot of people are like OpenAI, like, how can they leave? They're just on the verge of doing AGI. It's like, I'm like, I got $100 million. I got $1 billion. Like, that's it. I'm done. Like, I'm out. Right. I mean, what do you think?
I echo a lot of what Nick just said. At the end of the day, once you've crossed the chasm of like what I call like fuck you money, where you're like, you'll never have to work again, then you just have the decision of your life. And like, well, what do I want to do with the rest of my time?
Right.
And I personally find it, if you're a competitive, interesting person who has a lot of curiosity and is looks for resources and breaking barriers, like I feel like leaving seems very shocking to me. Like I would not be the kind of person that would say, hey, I'm on this rocket ship, I already have my money, it's locked away, but my money's like mine, it's not going away. Like I don't think this is going down anytime soon. You could take money off the table, still stay. And the fact that they're choosing to leave now, I think there's some negative signal to that. I do understand that 6 years is a long time, 2018 to 2024. It's not that long of a time. I mean, look, at the end of the day, the founders of Google are still cranking away and they're not day to day every day. Sergey's still submitting. He's doing push requests and pull requests to Bard or whatever AI model they're doing. So like, I just find it a little interesting, but I get it. Like at the end of the day, it's your money. You have the right to do whatever you want with your time and your money. And if she wants to leave, she wants to leave. Right.
Right. Go ahead, Clint. What do you think, man? I know.
I don't think this was. I mean, when you're talking about the money, right? Money ultimately, that's such a relative concept in terms of each person's like purpose and direction and concept of lifestyle and what what they're trying to achieve. I think this was more about the shift away from nonprofit. I mean, it was an interesting response she made. She said she's going to pursue her own exploration. I have no idea what that means other than she's going to explore a lot. But I think when you start to get a lot of change, everyone knows there's books and courses about organizational change and resistance to change. And I think that there has been a major structural shift at OpenAI as they're progressing into the company or evolving into the company that they are becoming. Progress is a perspective as well, I guess. So as they're evolving into the company they're becoming, I think it's not always a fit for those who started the journey with a different vision in mind. And I think that's what you see here. So
Yeah.
whether it's negative or positive, that's going to be known with hindsight. At the end of the day, I think that's ultimately what's going on here. I don't think it's about the money. Although that probably makes the decision easier in terms of free.
Okay.
I always, when people ask me do you want to make a lot of money? I want to make enough money to where my daughter has the freedom to say no.
Freedom. Amen.
That's a very important thing
word
to me. That's not necessarily a dollar amount, right? It's mainly about education. It's about a lot of things, but ultimately giving, having that freedom to say yes or no to what you want to do and choose the projects you want to do. That's the position. Most of these early, I would call them founders, collective founders, but early employees or founders of this organization. They're at that point right now.
Right. Well, but there's some interplay between how soon you have that kind of freedom or FU money, right? Like Evan called it, versus how much like shit you're going to take from other humans that you work with every day, right? So like, there's like everybody works with people, right? And for your colleagues that at a company that you work with, like you don't always agree with every decision, right? Sometimes you like the fellow you work for, the lady you work for. Sometimes you don't, right? Sometimes you like the strategic direction. Sometimes you don't. When you don't have that wealth, right, you just have to hang in there and eat it and go and move forward, right? All of a sudden you got more money than you know what to do with. You're like, I don't have to do this anymore. Like it's easy to hit the eject button and just go, right? And I can't even imagine this lady Mira. I can't even imagine the pressure that she's under, right? She's on every time she does an interview, the media torches her because she says something incorrect. I mean, it's just a lot of pressure, right? So how do you look at your account and see that dollar amount and be like, why am I doing this? Like, I understand the work is really interesting. And there's nowhere else on the planet that you could probably do that work. But on the human side, right? Which I think no one really is taking into consideration with these poor people at OpenAI, that there's like a lot of reasons to go. You know what I mean?
But Aaron, like, look, all four of us on this call are founders and have founded a company. And I wonder, I imagine that all of you feel the same way. Your company is your baby, right? Like it's more than just an income stream. It's like the thing that you're building from 0 to 1. There's obviously the founder ride is a roller coaster. All of us have experienced that. And remember, Mira joined a nonprofit. Like she joined this business without the expectation of making a massive.
Let me cut you off. Let me ask you though, do you think in my experience, there's owning a company, having 50.1% of a company, you control it. And then there's co-founding a company where you don't control it. Those are, in my experience, those are two very different things, right?
I don't know. I might, if I see where Evan's going, if he's going like the cult-like direction, I actually would really wholeheartedly agree. It doesn't matter if you own 51% or 5.1%. If there are enough of you that have the similar ethos, you're grounded in that nonprofit idea or ideology that you want to keep going. And then there's a bifurcation of where the product starts going and where the kind of spirit of the company goes. And that is when I think you have that bit of a chasm maybe. So sorry, I don't jump in on Evan because I think you're actually going in a really interesting direction on that, right?
I mean, that's exactly what I was sort of aiming at, right? Like I think people obviously there's a capitalist element of a founder trying to build a business to make a lot of money. I think that's perfectly reasonable, and a lot of people do that. I would say
why you start a nonprofit. Yeah.
Correct. I think the founders of OpenAI probably had a different mentality when they started this business or this project, I'll call it.
Right.
I do believe that, yes, money can change the perspective of things. I imagine that, just to what Nick said, like, probably the culture and the ability to drive change, or the ability to that own priorities or determine the roadmap, probably will impact whether or not someone wants to stick around. But I do find it a little bit alarming that you're on this rocket ship with all of the resources, all of the momentum, everything you've built is, and look, at the end of the day, this isn't a public company. They've generated a few $1 billion of revenue. I would say that the road ahead is far brighter and interesting. To leave now certainly is a little bit surprising, especially because, you've put so much into it. It's like, I don't know. It's just a bit startling for me to like think through the mental hoops of that. But I also, again, everyone has their own different priorities and things change over time. That's just the way life is.
Well, I got to tell you, fellas, I talk to tons of entrepreneurs, and my advice to them is to treat starting your company like a trade. Like, don't get married to this thing, because you got to think rational. Like, ultimately, you own stock in a company. You just happen to work there and run it too, right? But if there's an opportunity to sell at a great valuation or a great revenue multiple or whatever, like you can't just be married to it. Like, I can't tell you how many financial advisors I work with where they have clients, right? And their clients are long in the tooth and they should have sold 5 years ago and they haven't sold yet and they can't understand why. And more of it has to do with the human side of things than it does the business side of things, right?
Yeah.
And I just think with OpenAI, I think the human side came into play with these people, right?
Absolutely.
And they hit the eject button. So
yeah, makes sense. I mean, there's a famous Mark Zuckerberg quote where he was asked in 2008, what was he going to do after if the company IPOs and he makes $1 billion, like what's he going to do? And he's like, I was told early on that Facebook's a really good idea, and I don't think I'm going to have a better idea than Facebook, so I may as well stick around.
I love that.
Yeah.
Yeah,
Okay,
I absolutely love that. Yeah.
So Nick, I should know this though. Nick, maybe you guys know, like, but he has like super voting shares in Facebook,
He does,
right?
Yeah.
Yes.
Control.
I agree.
Control.
That's a very good point.
Like this is and I think Google was like that too, if I'm not mistaken. Like that, like
it is.
I think Sergey Brin, those guys, they have control. Like that there's something, if you can control it still, like Zuckerberg's a perfect example. He's like, I'm doing AR, augmented reality, and I'm going to dump $15-20 billion into this thing or whatever he spent on that. And everyone's like, this guy's crazy. And the stock pummeled, like toilet bowled and the whole thing. And then he kind of did it about face. He started focusing on AI and it's come back, right? But like, this was 2 years ago. To your point, Evan, he had control. And where else could you invest $20 billion? He couldn't do that anywhere else, right?
So maybe he could. He's probably one of the only people that could.
No, but you get but he's now controlling that balance sheet. He can do a lot with that, right? You can do a whole bunch of different things. But it's control, man.
I think at the end of the day, what this has really shown is that Sam is a shark and he's in control and everybody else is just a pawn on the board. And if all these other guys are leaving, that's not again, none of this is to say that OpenAI is on a bad track. I think Sam being in charge could still be an excellent tailwind for the company, but it certainly shows that the fun days of this is a project for AGI and the betterment of humanity is over, and now it's like profit P&L and make this thing a gajillion dollar business. And I don't know if everyone was on board with that, but they don't have to be because Sam's in charge.
Yeah, you're right. Yeah.
And just to give a small shout out to Mark Zuckerberg, who I know won't listen to this, but on Twitter, I pulled up his 2016 10-year roadmap, and he has pretty much nailed every freaking aspect of this. So it's all the products between video, search, WhatsApp, Instagram, etc. And then the last are the technologies in and around connectivity, AI, AR, and VR. And then if you look at what he presented last week with regards to the glasses and all the new technology, dude's outrageous. Like he nailed this in 2016 of where he wanted to be, and that longevity is massive. So just to kind of err on both sides of that coin that Aaron, you mentioned, like don't be married to it, be available that it's going to be a trade. You can also look at it as the Buffett sense of, I'm in for the long haul. I peaks and troughs and really wanted to hold on to this stuff for ages. And then if you look at his investment life cycle, that's kind of where I err to. Whether it's a non-trader or just kind of focus on the long game. I mean, that's always where I lean. So this is interesting because I really want to know where she ends up.
Yeah.
I don't think it's going to be like this. I don't think it's going to be OpenAI 2.0.
I think we're going to see more scenarios like this with these pre-IPO stock companies that are staying private for longer, right? I mean, OpenAI had a dramatic increase in valuation in like a very short period of time, right? And
Right.
we'll probably see but I wouldn't be surprised if we start seeing similar stuff from like folks at Anthropic and CoreWeave and some of these other companies that went from like zero to like several, tens of billions of dollars in like the span of 3 or 4 years time. I mean, that's a lot of wealth creation. If you're a CEO of that place, you got to be thinking about how am I going to hold on to my people, because those are very wealthy people now. Either do the trade and go and start your own company and be a CEO and you own 100% of it, you have control, or just go to the beach, or there's a whole bunch of different options now, right? So I think this is going to be a trend that we'll start to see in the next couple of years.
Didn't Ilya raise $1 billion for his new idea?
Yeah.
So she's probably looking at that being like, well, whenever I want to do my next thing, there's probably, $1 billion there for me.
And have control, 100% control. Like it's freedom. It's like what Clint said, control is freedom, right? So that's all. It's very interesting to me. I look at Twitter, I read the news. No one talks about this human element and how much money they made. No one. I haven't seen a single article about it.
Yeah, it's all bots, man. Don't worry.
The lady's a billionaire, and no one brings that up. I mean, there's like, come on, there's not even that many billionaires in the United States. Like, she's a billionaire, and like, I think it's different math than at that point. But anyway, let's talk Chime. So Chime's like hired Morgan Stanley to do an IPO. Okay, 2025. Yeah. Here's the thing: where do you guys think this thing's going to come out at? I know we don't have access to the financials, right? But it's at $9.2 billion in the secondary market. Okay, it's down from $25 billion. That was in September 2021. My math has it at 63% down, right? Negative performance since its last round. They are profitable. So this first quarter, this past year, was their first profitable quarter. So, I mean, what do you guys think about maybe the easier question, like Clint, maybe we start with you. Like, what do you just think of broadly about fintech, right? And kind of its prospects, perhaps in the market, in the public markets?
Yeah, I mean, I think I like fintech. The IPO market has been, kind of post the IPO has been really, really weak. So that's the only kind of concern I have for Chime on an IPO is what happens in the first year post IPO. But we do see liquidity increasing. I think a lot of that's a lot of this capital markets stuff is just related to Fed policy and credit access, and you're starting to get liquidity increasing in the marketplace. The Fed reducing rates is helping. That's generating animal spirits. You've got monetary or financial conditions. If you look at the GS Financial Conditions Index, extremely loose. So I think now's a good time to start discussing this in terms of where they price. I would assume, because I think the secondary market is a method of price discovery. You have transactions. I would assume that it's call it within that. With right around that range, maybe plus 10% or so. I think that's where they should price it. That would be my expectation. I think there's going to be appetite for fintech and fintech related companies as they go public, especially if they're profitable, because there's so many ancillary revenue sources and ability and widgets, dials you can turn to increase profitability and margin in a fintech business. And I only expect productivity to rise in an asset light business or a capital light business from a capital and equipment expenditure perspective. So I actually like I like this name. It's cheap in my opinion, but we'll see how the IPO performs. IPOs have been funny.
Yeah, they're definitely been tough. Nick, maybe I'll ask you to give us some insight on what the secondary market looks like, but maybe when you're pulling that up, like Evan, what are your thoughts? Go ahead. You got it up?
Just because it's complementary to what Clint put out there. This will be hard to describe. So in the notes or in the comments, I'll add some charting. But if you're looking at the revenue, we work with Contrary and Sacra, both research outlets. We have some insights there. They grow 2020 from 600, 2021 and 2022. They were pretty much at 950 to 1 billion, so really stagnant right in that period. And now they should be up at about 1.3 billion. So to Clint's point, 2019, 2020, 2021, they were floating between a multiple of like 24 to 30 all 3 years.
Right.
cut in half 2022 down to 12, and then chopped yet again. They're at about a 4.5. So to Clint's point about it being cheap, I mean that's really pretty cool.
Yeah.
For a direct revenue multiple, it's not the same as the PE. So I ran that for like Bank of America, and they're at like a 3, and
Right.
they're growing at 5%. So if these guys are able to not do a 30% per year, but maybe somewhere between 0 and 30, that's pretty interesting. And then when I put the chart up in the notes, you'll see kind of they bounced this Q1 off of their 2019 Series E. Then we're halfway back to where their Series F was, and it's a steep discount, like a 2/3 discount to their Series G, which was a 2021. So really, it's a wild swing, and no one really wants to admit to there being so much volatility in the secondary markets. But this is a name where a lot of people thought this could be dead. No growth between 2021 and 2022. The whole sector's getting hammered. What's going to happen? But now they're really coming back with rates coming down as well. Like, yeah, this could be an awesome buy.
Yeah.
This is pretty cool all of a sudden.
So Evan, you and I have done some stuff in banking, right?
Mhm.
And really related to Chime. But Chime's like a interchange revenue business and a spread. Well, I don't know if I call it a spread business, but they make like a revenue share on the deposits, right? The interest on the deposits. So what do you think about just maybe Chime's business? Like Nick read through some revenue numbers and everything, but what do you just think of their business model? I think you've said in the past it's kind of a tough business to drive
It definitely
profitability on.
is, and we've talked about it a lot. It's definitely tough. Aaron, you'll appreciate this, but like, look. So what did we say the value was, or the expected value right now? It's around 9.2.
9.2, yeah, that's what I got it.
So and they did what? A little under $1 billion in revenue. Is that what we said?
1.3.
Okay,
Yeah.
great. So in 2023, SoFi did $2.1 billion in revenue, and their market cap is $7.8 billion. So they did double the revenue on this very similar business model. Plus, they have the banking license, and their valuation is $2 billion less, and they're trading in the public markets, and they've been crushed.
It's a good comp.
This is really just the private versus the publics. At the end of the day, it's like opportunity. Now, look, being a bank, SoFi obviously has lots of limits on the business lines that they could have because they have to have banking related businesses. So to your point, your question, Aaron, like Chime is in a much better position in terms of the opportunity to generate more revenue because they can operate in different business lines that are unrelated to banking. So I think that probably warrants a little bit of a valuation bump. That said, do you think it's really worth 2x for SoFi right now? I find that very hard to believe.
Super awesome comp, Evan, because they're growing at the same rate. It's like,
there you go.
Banging.
Yeah,
that's an interesting one.
The other thing too is I got to tell you, like so with two primary revenue streams, the interchange and the interest on deposits, right? Interest rates are very high, and they have been, right? So it doesn't surprise me that they're profitable in the first quarter of this year when they were literally like maxing out, right? The total amount of revenue they probably could get from those deposits. But as that comes down, I think that's going to probably make it a little bit tougher on the revenue side. So I'm like very interested. This business, Chime business is an eyebrow raiser for me. Like to me, I think it's very hard to drive a profitable business when your primary driver of revenue is interchange. Like I've yet to see a company where interchange revenue is the only thing that they're doing, and they're able to drive proper financials, within the business. So I don't know. I'm like really intrigued to see where this is going. I did see some articles, and there were a couple of VC firms that had Chime up in like the $17 billion range they were marking it at.
Wow.
I don't know.
It's pretty expensive.
This one's going to be really interesting, So, but maybe on this point, let's just hit this last one, Evan. Sorry, let's hit this last topic here. So what Clint mentioned earlier, he's like, if the secondary market's at 9.2, I would kind of expect the public markets, it would be something in or around there, right? For Chime. This kind of brings me to the last topic. So like Wiz is out raising right now, and CoreWeave's out raising right now. So, Wiz has, they're out there kind of talking about a $15 to $20 billion valuation. The secondary market has them at 18.2 billion. CoreWeave's raising at 23 billion. The secondary market had them at 22.3 billion. Okay. So like this kind of begs the question, like, is the secondary market now starting to like influence the primary market? Right. Which I don't think has really happened in the past. But I don't know, Evan, like, what do you hear? Are you hearing anything out there in the market where people talk about secondaries from founders and
Uh,
whatnot?
the only time I really hear about it is on the companies that we've talked about in the past that are doing those tenders, the Stripes, the
Uh-huh.
SpaceXs, the OpenAIs. Like those are the only time when you really hear the secondary market really dictating the valuation, because there's
Yeah.
such a demand for shares that the price, anyone, it's just like shove and take my money. People will pay it for whatever. I haven't
Right.
really seen it as much on. I think that as we've said on this show many times, I think that we're seeing a lot of marketplace dynamics in terms of finding real price discovery here in the secondary market and what people are willing to pay. And I think it's been pretty spot on in terms of the investor demand. So I wouldn't say that I've seen secondary rounds really determining the valuation of a company, brought like a new fundraising round or an IPO.
Right. I mean, Nick, what do you think? I know you're like living, eat, sleep,
Yeah,
breathing in the space, talking
I
to a whole
just see
bunch of
it.
different stakeholders, right? Yeah.
Yeah,
What do you
we
think?
definitely see that occurring in the secondary markets on some of these bigger names, but it also goes both ways. So it's really interesting where if the secondary market is suggesting a price, invariably it will have some influence on where that primary occurs, is like at least what we're seeing in a lot of cases. But then often if the secondary market ends up getting away from where that primary round hits, the secondary then also can potentially revert down
Right.
or up back to where that primary occurred. So it's almost like there's a bit of a dance between the two. And then oftentimes I would imagine, when you hear about these rounds are coming, that's when the secondary market tends to react a little bit as well, because people are like, whoa, well, it's a foregone conclusion that this is going to occur here. And this is where we've brought it up on like a Revolut or a Stripe, where there's an
Right.
expectation of a future price, and maybe some of us call bullshit on it,
Yeah.
but at least it does start to factor into the secondary market. So I do think it's a bit of a push and pull on that.
Yeah. I mean, so Clint, what do you think about this interplay? I mean, look, if you're a CEO, like let's say Clint Sorensen, CEO of a tech company, right? What are these pre-IPO tech companies?
Man, you're in trouble.
Right?
Oh boy.
If that's the case.
Right.
You're in
But I
trouble.
mean, there's like if you got to do 409A valuations, like there's, your new employees are coming in, you're granting them stock, like all this stuff. Like, are you looking to the secondary markets to say, hey, this is where we're going to give you the stock, or you just kind of default to the last primary, or is it specific to the market? Like maybe you don't want to give stock at the last, valuation.
It's company specific, and I think it has everything to do with the depth of the transactions, who's participated in those transactions.
Yeah, that's a good answer.
I would lean on the secondary market, but I would want to see depth there, and I'd want to see big players, biggest sophisticated players taking and giving prices that are reflected. You don't want to see it just run because you've had a lot of smaller transactions with less astute players. I think that would give you a false reality, or someone who's forced to sell. So I would rely on the data, just because data is important to rely on, right? And you're kind of trying to figure out how to price these things, and I feel like that's a market-based pricing mechanism, and I'm all for market-based prices. So I think that would be the direction I would go first, but obviously you have to consider the breadth and depth of the market before taking it as gold.
Yeah. Well, I will say this, fellas, when we started doing this, I think we started doing this maybe a year ago, right? 15 months ago, right? When the secondary market, I felt, had kind of a negative vibe to it, especially from folks on the West Coast, right? Now, totally different. Now I hear VCs bragging about how they sold in the secondary market to generate, cash so they could distribute to their investors, to their LPs, right? I'm hearing, like Evan mentioned tenders earlier, right? Like, CEOs are doing structured tendered offerings so that their existing employees and shareholders can get liquidity. Like, this is becoming, I think, the secondary market is becoming like a very important part, and it's becoming like institutionalized, and people are accepting it, right? I mean,
Absolutely.
What are your thoughts on that?
Yeah, I mean, that's part of the reason we founded PM Insights, formerly ApeView, right? Because we saw this occurring in the loans market that has a great secondary market, We saw this happening in the asset-backed security market, in the municipal bond market. All of these other OTC asset classes that have many different broker dealers, that sort of setup. This shouldn't be dynamic in its differences to those by all that much,
Right.
So yeah, the writing was on the wall, in a lot of cases, and I think the only people upset about it are probably the investment bankers that it might be missing out on some of these primary rounds because we can facilitate with secondary or tenders or other mechanisms, right? So yeah, totally agree.
Nick, one question about that though, just to be a little bit of devil's advocate. Those other markets that you demonstrated that had very strong secondary markets that ultimately had data to support it and became more mature, I feel like those markets had really strong underwriting practices historically versus in venture, which I'm going to call this secondary, or the market that we're operating in, the private markets of venture, seems to be very different in the underwriting mechanism. A lot of the people making these primary investments, they're not investment bankers, they're not analysts, they don't sometimes can't even look at a P&L or an income statement and really tell you what's going on. So do you think that could ultimately have a problem with the long-term play of this market?
I think with more data, it will start to price better. So primary rounds will be priced better because I think you're absolutely right. If you do the bond math on new issuance, right, from any of those other markets, 3 banks are not going to come back to you with abstractly different views as to how something should be priced, right? Mm-hmm. Here, that absolutely happens, and it's going to happen every day. And this, I think, has to be a market that is always going to have some subjectivity to it and some art, because when you're valuing a company, you might not be valuing the company. You might be valuing, as we started this podcast off this week, you might be valuing the founder team, where you think they can take it. Where you're valuing an asset-backed security, you're looking at the future cash flows, the probability of default, the California ratios, the war, all that stuff. It will never be the same, but the dynamics of how it can transact in primary and secondary worlds, I don't think that's going to be horribly different. But the pricing of it, it's still going to be more Wild West.
Look, I'd offer there's going to be a maturation cycle. You know what I'm saying, Evan? So I would say it's definitely more Wild West now, right? And I think to Clint's point, as markets get deeper and there's more sophisticated investors come in and start to play in the space, they'll require more data. So some institution will come in and be like, yeah, I'll buy Chime for X, but I want full financials on that trade, or I'm not doing it. I just won't do it. So, I think you'll start to get, and then as more people do that, then that just becomes the norm. And then the lawyers know that and the founders know that. And it's just something that they offer. And it's not this taboo thing that you're going to open up your books to people. That's one example, right? But I can see that. I can see things getting more sophisticated and more quote unquote institutional, right? As the market gets bigger and deeper and more players start to come in. Right.
The amount of privileged information will start to decrease the later these companies get.
Yeah. There's also just standardization too. I would love to see a lot of the stuff that trades is SPVs, it's LP interests, right? But every single different SPV has different fund docs. There's no reason you can't have a Y Combinator SPV fund doc type thing where all of them are the same. You know what I mean? And then you don't even have to think. I don't have to have lawyers look at the documents. I don't have to do any of that stuff. I can just sign it. It's simple. This, when you do a trade through an SPV, this is what happens. Everyone does the same thing. It's kind of agreed to. Then you can use technology. You can get technology in there now because there's standardization. So all these things, I think it's a natural, maturation cycle. That could happen. It also could not happen, right? So, but I think
it should happen.
It could happen. Yeah,
it should happen with technology. That's the idea, right? Over time, this stuff should the more mature it gets, the more standardized it will become.
Yeah, I mean that's certainly true. It's just that you got to get there's a lot of law firms out there who obviously are making money on reviewing fund docs on every single trade, and you know what I'm saying. So somebody's gonna get some food taken out of their mouth on this, and so you'll get resistance. You'll get resistance, right, from some people. But I'm just fascinated. I'm fascinated to hear a lot of commentary come out of Silicon Valley now, where people are very much embracing the secondary markets. right? And I think that the vibe that I was hearing was like, this was very not like founder friendly to be selling shares in the secondary. And now that's kind of, that commentary is shifting a little bit where it's like, look, if you're not going to go public, then this is something we have to do. So you got to get comfortable with it. Right.
Because now it's not just circumventing the VCs, it's inclusive. The VCs can benefit, as we were saying last night with DPI or any sort of aspect to make sure that they're rebalancing. But then when you do that, Clint and I probably have our bells going off and it's like, oh, is this just going to be like setting up Aladdin for private markets and we have to understand like my attribution and everything like that? And like, yeah, probably so.
Yeah. But I also think too, I mean, last point to talk about is just I also think now that the secondary markets have kind of taken hold here over the last 4 or 5 years, founders, I think, are realizing the benefits of the secondary market. It's not all bad, right? That someone's trying to sell. They get a price on the stock. They get information on where investors want it. They got less pressure from existing shareholders to get liquidity, so they don't have to go public if they don't want to, or the market timing isn't right, or whatever it is, right? So, I mean, I do think I'm getting the sense that from founders, like they're starting to recognize the benefits of the secondary markets too.
I think that it's obvious facts and circumstances, and it depends on the company. Because there are certainly examples, and I'm sure we've all heard them, of companies where the founder raises some mega up round, raises hundreds of millions of dollars, Series B, Series C, takes 25 million off the table, and all the company's not doing the company hasn't generating revenue, and suddenly they're like, oh, I'm replacing myself, a new CEO. I think I can name 2 or 3 companies I know of that have had that, and that's probably a bad example of early liquidity incentivizes the founders to take the money and get off and not worry about it, versus companies that are Series D, F, G, where they've got stable business models. Like I think it does really matter about the company, which is why I think when you have investment advisors who can really like do the work to help investors understand like, hey, like what's legitimate, what's not, and then also having data platforms that you can validate information from, especially when it comes to financials. Because I mean, having run a startup, I can tell you it's, the smaller the company is, the earlier stage, it's more likely the books are not that great. Hard to manage. So you got to make sure like, okay, I think all of us should be investing in some sort of like a late stage startup auditor. Really affordable auditors that can provide financial statements for investors for the secondary market seems like a great opportunity for all of us.
Yeah, it's interesting. Well, I think this, I mean, this is obviously self-serving, right? But I do think we've already seen a lot of change in this market in the next 2 years. I think it's only going to get better and kind of more robust. I mean, like, look, I don't think it's going anywhere. I'm actually super interested to see what's going to happen with IPOs. I have now started to tell my LPs that I'm not worried about IPOs. We can sell in the secondary too. So
you've always said that, haven't you? You've always said that.
Yeah, I know. But like a lot of people, I think, call me and they're like, oh, we're going to buy. And then when's the IPO going to happen for this company? Right. And I said, oh, listen, I think like best estimate, no one knows, but best estimate, I think it's here, maybe here. But also too, if you want to sell in the secondary, we can sell in the secondary. So like that, when you got people round tripping now, coming in and exiting all in the secondary market, that's another good sign of a robust, deep market, right? Where I think it's only going to continue to grow. So, and that opens up a whole different slew of then questions around asset allocation. It's a lot, right? There's a lot you can do there, right? Because it's not like you're handing money to a venture capitalist that's then going to turn around and like, do active management to think about what maybe I'll buy this company or that company or this company. You literally know what you're buying ahead of time. I'm going to buy these 3 stocks. That's different, very different than I think how VCs operated in the past, right? So it's pretty intriguing. But all right, fellas, let's end it there. I appreciate you guys. Thank you.
Yeah. Thank you.
Thank you guys.